What's going on, guys? Welcome to the Geeky Investor, where stocks talk and we translate. Today we're going to be seeing how Adobe stock is really getting hammered after the earnings call. So let's dig deep into the earnings call and if this is a reasonable downtrend for the stock and if this is a buying opportunity for us. So before we proceed any further, let's first look at the stock right here. So I'm going to be kind of refreshing the page right here. So as you can see, within the past 5 days, the stock is down 10%. But specifically today after the earnings call, the stock was down by as much as 8 to 9%, reaching $248. And now it is sitting at $252 as the time of the recording of this video. So you got to be flipping my jacks right here. What is happening to the stock right here? Let's look at the earnings. Were they a bad earnings call that this really led to this kind of down going stock? Well, first of all, let's look at the earnings and the revenues. First of all, we can look at the revenues. So on the graph right here, we can see on the quarterly basis, Q1, Q2, 2025, and then all the way into Q1, 2026, which was announced just yesterday. So now, if we look, the revenue was 5.7 billion in Q1 2027, in Q1 2025, and then all the way into $6.2 billion. That is what they achieved, $6.194 billion. That was in Q4 2025, and now $6.398 billion. So that's an increase of around 12% on an annual basis when it compares to Q1 2025. So that's a very nice increase in that particular area. If we go on to the earnings per share, we can see that the earnings per share were up by almost 11%. So from 4.14 all the way into 4.16 earnings per share for Q1 2026. Now, you can see that the revenue was up 12%, but the earnings per share were up only 11%. Well, one would think two things either happened. Either the company's margins were down or the company kind of issued more shares. However, we're going to be seeing in just a moment from the income statement that actually their margins were the same or even higher, and they actually even repurchased many shares. So why did the earnings per share go down as is the growth is even lower as compared to the revenue? Well, the idea is because of the taxes. When you understand the income statement, this is because of the taxes, these one-time expenses that occurred for Adobe's company, which are mainly because of that tax credit kind of expiring, that big beautiful bill with the Trump administration and whatnot. So now let's read right here. So the adjusted earnings per share, the company reported $6.06, surpassing the forecasted 5.8 to 5.86 to 88. So as we can see, this they kind of surpassed the revenue expectations, which were sitting at around $6.28 billion. They came in at $6.4 billion. So they had a double beat. This is what we call a double beat when it comes to the revenue and the earnings per share. Well, why? Given that there is a very nice increase in the revenue and in the earnings per share, why did the stock go down? Well, before we understand that, let's look at their forecast, the management that have said for the revenue. Now, as we can see, for Q2 2026, we can see that the revenue is expected to reach $6.43 to $6.48 billion. Now, as you can see with the graph right here, there is a kind of slight acceleration when it comes to the earnings, when it comes to the revenue growth. And this is telling you that although the company is still maintaining nice growth and it's still been growing in the past couple of years, despite that, this year is expected to accelerate in revenue, and despite that, the stock has went down. So really, a lot of things that are happening to the stock, although they are positive, the analysts are seeing that in a negative way, and this is impacting the stock in a negative manner. However, I believe that there is a very big mismatch between the financials and the actual performance of the company. That's on one side, and then on the other side, we can see that there is a very large mismatch with the share price. So as you can see, the share price is down going, while the metrics, the revenues, the earnings per share, and the performance, the actual performance of the company is going in the right direction. Now, we can see that the subscription revenue, which is kind of recurring revenue, is 6.17 billion, way higher than the 6.08 billion that was expected by the analysts. I'm just saying way higher, although it's just 0.1, but when it comes to expectations for the analysts, that's called a big beat. All right, so now, if we see, Adobe generated a record 2.9 billion in Q1 operating cash flow. Now, let's look at, so if we go to stockanalysis.com, and this is Adobe, ticker symbol ADBE, and if we go to the financials and then specifically on the income statement, as you can see, if we go to the quarterly basis on the right side right here, we can see that the revenue was $6.4 billion, an increase of $12 billion, and 12%, and then a gross profit of 5.7 billion, operating income of 2.4 billion dollars. And now, as you can see right here, there's a very nice increase on a quarterly basis. If you look at this trend from 2021 to almost 5 years, you can see that the trend is going on the right side, which is the right direction, which is kind of going up. So the operating income is going in the right direction. Now, if we go to the earnings per share right here, we can also see that it's been also growing very nice way in the past 5 years, and specifically for Q1 2026, we can see that the earnings per share were $4.6. Now, if we go to the operating margin, it's 89.62%, which is in line with the prior numbers that the company has been posting, and it's kind of in line with the margins that were the company was posting since 2021. The same is happening to the operating margin, which is sitting at 38% or 37.79% as of Q1 2026. If we can see that the trend is kind of slightly upward trend, although the overall numbers are kind of the same, 35, 36, 37, 38% operating margins, with a total net profit margin around 30% for the company. Long term, it's stable, and it's a very, very healthy margin to see in such companies. Now, if we even go to the balance sheet, we can see that they have very nice cash and cash equivalent, 6.3 billion. And if we can see that their debt, their long-term debt is 5.3 billion, they have that decrease from the long-term debt into the short-term debt, which is expected to be paid within the next 12 months. All right, so we can see that their net cash, which takes net cash debt, which is basically, as it says right here, total cash. So as you can see, total cash minus total debt is now on the positive side. And this is very nice to see, a very healthy balance sheet for the company. Now, unfortunately, the CEO has stated that the longtime CEO, Shantanu Narayan, sorry, I didn't pronounce his name in the appropriate way, but it's a bit difficult for me. Maybe you guys can correct me how to pronounce that. However, he announced that the plans to step down once a successor is found. Now, it does not mean that the company will not have a CEO at the current time. Basically, what is happening is that the CEO has told the shareholders and the investors that he is planning to exit the company, and kind of, he's not gonna retire completely. He's still gonna remain in the board of directors. However, the idea is he's telling investors that I will be stepping down once we find an alternative CEO that would take my position. So, at first, I thought that this is a negative statement to say, because I thought, telling investors and shareholders that you're gonna leave while not actually finding an alternative CEO is kind of bad looking. However, this is the normal culture and the normal thing that happens with these large corporations, is that before they step down, they tell shareholders, they are honest and direct with the shareholders, because at the end, we shareholders are the owners of the company, so we have the right to know when the CEO, what he's thinking and what's his expectations, and if he's going to be stepping down or not. Now, we hope that the new CEO is as good or even better than the current CEO, and he would lead the company with a very nice trajectory, given that there is a possible AI competition that a lot of analysts are talking about. Now, this statement right here is one of the big reasons why the stock was down today. Now, if we look at the total annual recurring revenue, and now I explained this in the place right here. So this annualized recurring revenue is the total annual value of all active subscription contracts and at the end of the quarter. Well, what it does, it is a speed meter for the business, showing how much predictable revenue Adobe expects to earn over the next 12 months if no one cancels. So basically, they are expected to have 26 billion in revenue for 2026 if no one if no one cancels their subscriptions for Adobe, for Photoshop, etc., etc., etc. Now, the same is happening with RPO, which is basically what I write, what I say about it right here is the remaining performance obligations. It is basically the deferred revenue that money is already paid by customers for future services that are expected to occur in the future. So basically, what happens is, if you want to subscribe to Photoshop or Firefly or Adobe Acrobat Reader, you're going to have to pay, for example, 1 month ahead, or you're going to have to pay a year ahead. Well, if you paid a year ahead and now we're on Q1, well, what about the payments that you paid for Q2, Q3, and Q4? Well, they are found right here in the RPO, and that is what is represented right here. Now, investors are worried that the new AI-powered tools from competitors could replace Adobe's core software, and that is why the stock overall has been trending down. If we go back to Google, on Google, we can see that over the past year, the stock has been down by almost 33%. And if you look back, this level right here, $252, is as low as 2019, which is really, really interesting to see. Although the company, as I showed you just a moment ago, that their financials has been improving since the past 5 years. So over the past 5 years, you can see that it's been growing in a really nice and steady manner. And despite that, the stock is down and hammered to this value, which kind of reminds me of 2022, when we had many chances and many opportunities to buy all of these stocks, these cheap stocks. And if you even go back to Meta stock, if you go to and see Meta stock over the past 5 years in 2022, you can see that the company the stock was down going, and then after that the stock increased by 5 to 6 times. Because what was happening to their financials? Well, let's take a quick look. Now, this is Meta, Facebook specifically. As you can see, over the past 5 years, the revenue has been growing steadily in a very nice manner. And despite all of that, what happened was the stock was down going, but this was a very nice opportunity to grab some shares. And this, in my personal opinion, the same thing is happening with Adobe stock right here. So the final thing that I wanted to say is that the analyst Jackson Ader noted that Adobe's future guidance implies flat new annual recurring revenue for the year, leading him to lower his price target for the stock, and that is one of the reasons why the stock was down. Although, again, I think that in the long term, my personal opinion is that it's going to be going maybe up to 2 to 3 to even 4 times the current values. That's my own personal opinion. You're going to have to make your own decisions and make your own research. Let me know what you guys think in the comments down below, and I'll see you in our next video.